purpose of this is to give you a flavor of where you eventually want to get to in trading. The majority of courses that are taught on trading all are done with mechanical references, standard references. They all sound nice, and if everybody's got the same numbers, if everybody's got the same numbers, the same things, they really aren't likely to work very much. So what we're going to do, we're going to take you into some depth here and really try and give you a feel of where you need to go. So we're going to start off right here. And the first thing I want to show you is the low of, today is the 18th, and we want to show you the low of the 17th before we start off. Okay. Key piece of information. The low of the 17th is exactly at the high of the lower distribution from the 16th. Now, a lot of people will look at that and they won't have any idea what I'm talking about. When the market broke on the 17th, it broke and it went to an exact reference. When markets go to an exact reference, and that's the high or the low, we classify that as a weak high or low. So coming into the 18th, we're looking and we're saying that the low of the 17th is a weak low because it is exactly at a very mechanical, easily identifiable high, which is the the lower distribution from 1016. Okay, let's look at the other end of the market. And on the other end, what we have is we also have a weak high. And it's considered weak because it is a single tick away from the high of the 16th. So when we come into the day of the 18th, we are looking at two weak highs from the previous, one weak high and 1 week low from the previous session. Now, even though the previous session has a weak high, we're coming in today and we have a negative bias on the day because of the way the previous day traded. It didn't have a lot of volume. It didn't have a lot of pep. So we don't need to spend any time on that right now. There's a lot of other things we could talk about. But with that background, we're going to go in and start trading the 18th here in a couple minutes. And just to give you some feel of where you want to go. So before we open the 18th, we're looking at overnight inventory. If you look at the settle price from the 17th, Jen is pointing it out now, you will see that 100% of the overnight trade took place below the settlement from the 17th. When that is the case, we consider that overnight inventory is 100% short. Now, what does that mean? It just means that it's way below the settlement for the day before. Generally speaking, overnight traders are weaker hands traders. The really big traders don't trade very often they don't trade very much at night because the liquidity is too thin. In other words, if they're trying to get an order filled of some size, it's very frustrating because it just runs the market because the volume is so thin. So we're coming in with overnight inventory about 65% of the time, and that's not a scientific derived, perfectly studied number. It's from observation. The early morning trade will trade counter to overnight inventory. So if overnight inventory is short, the expectation is for early trade that trades back up and corrects the inventory from overnight. If the market is really weak and it doesn't go back up and correct the overnight inventory, then that's a sign that the market is very weak. In other words, if the market doesn't correct overnight inventory, that's an indication that the market is fairly weak. Okay, with that background, we're going to play the 18th. So Jen has started now. We're going to be, when the 18th comes up, we're going to be looking at it at 2 times the normal speed. So it's not quite the actual speed that takes place, but it's just a little bit faster. Okay, so you see the market starting to move down there. And what you see is you're seeing the last trade just before the market opens. So that's still the electronic trade from overnight. And as soon as the market opens, you'll start to see the letters of the profile start to show on the right. So we're opening down around the overnight low. And we're going to see what happens from that level. Okay, so the overnight, the market opens near the low from overnight trade, trades up a little bit. The low is weak so far because it's 1 tick above the overnight low. So that's got low odds of lasting. If you look at the 1017 pullback low, you can stop for just a second if you would. Notice the lower line, and there's a J on the left of that. It's pretty hard to see, but late on the afternoon of the 17th, that was the pullback low. In other words, the market traded down to there, just to below half back, and that's as low as it traded was to the J period low. So what we're saying is trading is about change. And if there is an indication of change, then one of the indications would be that we traded below the late pullback low from yesterday afternoon, or from the low of the 17th. Now that's probably something you're never going to see anyplace else unless somebody has taken, our courses. But it's a simple indicator, and trading is about change. So we want to see, is there change relative to the previous afternoon? Okay, let's go ahead and continue to play. Okay, so you see it came back, it took out that low, and then it bounced immediately. So the market knows where that is. So far, the market's fairly weak because overnight inventory is short, and the market hasn't done any correction yet. So the market's open, the market's testing lower. Just so you understand, where the prints are white color is light volume, pink is the second level of volume, and red means it's the heaviest level. So as the market trades lower in the morning, we're trying to get some idea of, is there much volume? Now we can look at the actual volume, but the schematic using the colors is very helpful to me. Okay, so value, we are below the previous day's value area. And the low of the previous day's value area coincides with that J period pullback level. So early this morning, the market is trading lower. So what we're looking for here, we're trying to see how much confidence does this market have? So many times what traders end up doing, they end up following price. And remember, price is an advertising mechanism. Time regulates all advertised opportunities, and volume measures the success or failure of those advertised opportunities. So the market is trading lower at this point. No correction to overnight inventory. We are below value from the previous session, but we are still within the range of the previous session. When we are in the range of the previous session, the odds increase that we will have rotational market activity. And a lot of times it will give us early morning chop. Okay, so we've opened. We're in the range of the previous day. The market is still pushing lower. Now we're just watching very closely. If it's really strong, we should start to see some volume build on the lower end. If it stays white down there, then that's an indication that, lower prices were cutting off activity. The reason we want it to get pink and red, we want to see that lower prices are bringing in more activity. So now the market, I believe, just traded one tick short of half back. Half back is always a very mechanical reference used by the daytime frame traders. So we traded to half back. Now we trade back down to the low. We are still within the previous day's trading range. And remember, we're playing at 2 times the speed in the previous day's trading range. Remember last time we were 1 tick short of half back. Half back's a kind of white line that's a little hard to see, but Jen can put your cursor on it. That's half back. A little hard to see in the first half hour, but half back is a classic reference for short-term traders. Notice one more time it went to half back and sold off. That's not a good sign when it's sold off from there a couple times. If there's any real strength, we don't go back up and be that mechanical. See it pushing. See it hovering around half back. It's 3 times I think it's been to half back. The chances are we're going above half back. When it's been traders are mechanically selling at a tick or two under. That's not strong. That's not strong selling when there has to go to an exact level to find sellers. See, it's still hovering around half back. This is the 4th time, I think. So as you're looking at this, to keep you from focusing on price, think about value. So your value from the 17th is on your left. Think about where value is building now. Think about half back. Okay. Now notice we said earlier, we kept coming back to half back, coming back to half back. Once we did that, we said it's pretty good odds that we're going to take that out and trade higher. I don't know how much higher, but that's an observation. And you should be able to see the opening. You should see half back. You should immediately be able to take in all these short-term references as soon as the market opened. So you should know where the overnight low is. You should know where the J period low was. You should know where half back is on today. Those things you're not going to take them in the first time. But as you've traded for a while, that becomes second nature. And that's what we call chunking. Chunking is just like you learn to back your car out of the garage. Once you've done it a couple times, you go out pretty quickly. First couple times, it takes you forever. The better you get at it, the smoother you get. All you've done is chunked a lot of information. Chunking is what allows you to get out of bed and walk down for breakfast in the morning. Okay, so now, not only have we been several times back above half back from overnight, we're back up and almost, I think this last time we traded almost to that J period high. So now we start talking about confidence. How much confidence is this market showing? So Jen, how far are we into the first half hour?
15 minutes.
Okay, so we're halfway through the first half hour. And notice how many times we've been back and forth through half back. Notice there's no real volume on the lows. We're in the previous day's range. So this is not, at this point in time, this is not something you classify as high confidence. That's a huge decision that you need to learn to make. Okay, so now we went back up. We're down below, we're down at half back again. Notice what a mechanical reference that is for the short-term traders. Back and forth through half back. Need to get a feel. These, we're asking you to take a lot of things in at one time. And we understand you're not conditioned to do this yet, but this, we're trying to give you an idea of what you need to know, where you need to really get to. We don't want to give you any false impressions that you're going to take, a couple week course and all of a sudden you're going to be a profitable trader. It doesn't happen that way. It doesn't happen where, you go to mechanical references and you buy here and sell here, or put your stop here. That's not the way. If it was that easy, we'd have robots doing it. There'd be no opportunity for you and I. Okay, so now we're back up again. We're back up. We went to the J period low. So we look below half back. We got above it. Now we're looking up. The next thing we got to see, the green dot is the high. So they're looking at. So they'll be looking at that because that's something they all know. So you traded for 15, 20 minutes on the downside, but now it's come back quite a ways. You've come back, you've gone through the opening. So we said if you open within a previous day's range, the chances are you're going to have a lot of chop. And it's being delivered to you today. You're getting the chop. Okay, Jen, let's speed it up to 4 times. There's a lot for you to be thinking about in here, and that's why you'll have this recording and you can look at it many times. But again, it's there to give you a feel for where you need to go. Then you figure out what does it take for you to get there. One of the things I'm hoping to focus on this morning is not focusing on price. So many times traders can't help but focus on price. And they say, well, of course I do. Well, that's not, like I say, how do you take it off? Take your attention off of it here. You say, okay, where was the J period pullback low? Where was the overnight low? What is the overnight inventory? Is it long or short? Where's the market building value today? All of those things, if you think on those, they will help take you away from just simply focusing on price. Price is simply an advertising mechanism. Okay, Jen, let's take a look at that's the low from the 17th again. Okay, so I just want to remind you that that's down there, just so you know. Okay, I can go back up, and how much time is left in the first period?
5 minutes.
Okay, so we're at 5 minutes, and we're going 4 times the speed, so it's not that long. So you saw it went back through half back. It actually went above the early morning. Well, not above it, but it got back into the high of the early morning. We're getting the chop. You see in here, you're getting a lot of indecision in here. If you're following price, oh boy, I want to buy it. Oh boy, I want to sell it. And you don't want to get in that trap. That's what following price will do. Will get you into that trap. Okay, so as we get near the start of the next period, we're back down near the low. So the question I ask you right now, is there high confidence or not this morning? Forget if price is up or down or value is up and down. The confidence, you notice how many times we've been back and forth through half back? We've been above the overnight low. We're going to change time periods here, and you look and see that we've got a poor low right now. AB low is a poor low. It's one thing. Okay, now we've traded below there. Got a little spike to the downside. So now you're looking to see, do you really have anything on the downside? Or are you going to rotate back up? Remember our earlier comment. we haven't shown the highest level of confidence this morning. Okay, so we extended a little bit on the downside. Coming back up, the next upside reference is going to be half back. Remember, that's a very mechanical reference. Okay, let's speed it up to 6 times earnings, or 6 times playback speed. So remember, we're going 6 times the normal speed. So you see it just stopped at half back. Again, very mechanical. So you saw them a couple times selling exactly at half back. Now we're back through half back. They're going back up towards that J period pullback low. Remember, this is 6 times speed. We went back up. Now we're back down near the lows. Just feel how hard they're pushing on the lows. Feel how hard they're pushing, and they're not getting much. Okay, we stop here for just a second. One of the things that we really wanted you to feel in here this morning is how hard they are pushing on the market to the downside. You're still within the previous day's range. You are below the overnight low, but you've now been going on, 45 minutes pushing the downside, and we got some range extension. But don't forget, in the meantime, we've been back up through back up through the J period high, or I'm sorry, up near it. We've been back through half back from this morning. So confidence isn't overly strong. If confidence was strong, you'd trade down and you wouldn't worry about that. And they've been pushing on the downside. And we want to see what they get. Okay, let's keep playing. Okay, pushing on the downside again. Pushing again on the downside. Pushing again. Couple more ticks on the downside. Notice how it comes back. They get a couple more ticks and it comes back in. Couple more ticks and they come back in. That, what you're looking at right there, you're seeing the action of how a market gets too short. Meaning they're trying to sell it, and they got very little. Even though you got a couple of ticks of range extension down there, they were doing an awful lot of work on the downside and getting very little follow through. So you have to be very much aware of that. That's where we're talking about getting a feel for the market. Let's stop for a second. What we always say is that trading is an art, not a science. Now that frustrates a lot of people because they want to know, well, I don't see it that way. Well, a lot of times they don't see it that way because that's not what they want to see. They want to see some order to the market. They want to have more assured ideas of where they get in the market, where they put their stops, etc. Those things just don't work. What we're talking about here, to make you competitive, we're talking about how hard that market was trying to take that low. It extended a couple times, but notice how far it came back. So those traders are getting very short and they're not getting a lot for their effort. Okay, let's go ahead and play. How much time is up in the B period?
A little over 10 minutes are left.
So keep in mind, 2/3 of B period is gone. Remember, overnight inventory is short. There's no correction to overnight inventory. As you're watching this video, it takes a long time. Don't give up on it. This is really important. Okay. So now we've gone back into the overnight range, only a little bit. Now look what they did. They went into the overnight range and they sold it off again. So when you take all morning, we're going on an hour now, and the range is pretty small. But ask yourself, is there high confidence today? And at first, you say, well, I don't know how to judge that. Well, we opened, we've been trying to go lower all morning. We got some extension in A period, and we got a few ticks in B period. But notice we kept coming up, back up through half back. We kept getting into, almost taking the high, getting back into the overnight range. So when we go to open, almost ready for the next half hour, we've basically accomplished nothing from the first period. Okay, let's stop for a second. So now what we said we didn't have confidence in the market to the downside. It was doing a lot of trading and a lot of push to the downside, and it was getting very little. But now you get fooled because all of a sudden, it went down, it took a couple more ticks out, extended, came back up, kept down, took a couple more. You say, well, it's going lower. And I say, yeah, it's going lower, but it's not really aggressive on that. So what happens every time that market goes down lower and you get a couple ticks or no ticks, guess what's happening? You only know it from watching, from observing what's going on. So when I look down there, now I made a comment today when we were trading. Everybody knows I came in with a short position this morning. And because it was the disclosure. But as the market was pushing to the downside here, I hedged my position. In other words, I went long futures to hedge my put position. Not that you're there to talk about options at this point, but I took a long position down here because it was working so hard on the downside and was getting very, very little. Back and forth through the half back several times. The point we want you to get right here at this point is the lack of confidence that was here this morning. There's no numbers to tell it. There's nothing other than the ability to learn to watch the market. Yesterday, we were doing a program and somebody asked me if am I in front of the machine all day or do I, when the markets are quiet, do I walk away? I said, no, if I'm trading, I never walk away. I want to see how everything develops. I may be reading a book and keeping an eye on it, but I never walk away from the market. Okay, let's go back and play. Understand, we've tried very hard to go lower this morning. We've gotten very little success. Now, see what's happening in C period. Remember, we're playing at 6 times normal speed. Overnight inventory is short. It's always subjected to a short covering rally. So we thought the market was having a lot of trouble getting much to the downside this morning. Your trick is, if you're only looking at price this morning, you probably get it through your head that the market was pretty weak. If you learn how to think about the market and how to think about the flow of what's going on, you may have gotten an alert that the market may have been getting too short. Okay, so now it's in C period. So we're in the third portion of the day. Overnight inventory is short. Let's stop for 1 second. Once we get above the early morning high, one of the things we're looking at, Jen has marked it, it says overnight prominent POC. The more prominent a POC is from overnight, and I can't tell you what's really prominent. You learn that from looking at it. This one is very prominent. The more prominent it is, the greater the odds that it will be revisited in the day time frame session. Now, that's just odds. That's not 100%. If you didn't even, the market went straight down, then you forget about it. But when the market didn't go straight down, confidence was low. And so you got to keep that in mind. All right, let's continue to play. Okay, you see the market's going up. It got one tick short of a very prominent point of control from overnight. Again, mechanical stop. There it goes, right back to it. Notice the hesitation at these references we point out. Okay, now we're through it. So now if there's anything here today, this market should keep a double distribution trend day. In other words, you should have a lower distribution, single prints separating it, and starting a new distribution to the upside. If there's anything meaningful on the upside, that's what you should have. So right now, you have the potential for that. Overnight or the C period got to the through the prominent point of control. Okay, now watch this very closely. I want you to see how low C period goes and how close it gets to getting back in that early morning range. See how close it comes down there, and then the people, they're buying it as close to that early morning high as they can get. If the market is really strong, you don't keep coming back there, you just go. Does it have to be that way? No. But now look at this. Look how close it came again. That's the piece of information you need to record. That helps you understand that the market really wasn't that strong. If the market was that strong, you wouldn't come back. We've come back twice to being very close to getting back in the early morning range. Okay, now we have a live market commentary. And on the live market commentary, I said, if the market gets back into that lower distribution, then the market, can do a lot more damage on the downside. Look at this, how often we're playing at 6 times earning, but 6 times speed. Notice how often it kept coming to trying to get down there. Now, weaker hands traders were buying every time it got there and they were buying it as close to the A period high as they could get. Close as they could get is what they were doing, because that's where they felt safe. They were doing mechanical buying. Okay, so far they bought. Now look what we're getting here. We're getting a little bit more range extension to the upside in C period. So go out and say, okay, if you get back down into that lower distribution, now you really have some potential on the downside. So a lot of times it may not look like that from here, but that was what I put out there, and that's what you want to keep an eye on. If you close off this distribution, then you got some short covering, but you didn't have new buying. You didn't have real strength. Let's stop for just a second. If the market got too short this morning and we get a rally in here, another concept that is very hard for people to understand. Short covering can weaken a market. If you're short, the only way you can get out of your short is by buying. So if the market's real short, that potential short covering is always provides some kind of strength for the market. If you cover that, if you go up there and the short covering is over, then that potential buying power is gone. So short covering can weaken a market. What you really want to see, if a market's got any strength, you want to see short covering combined with new buying, with new money buying coming in. So if you've got that combination, we call short covering old business because it's closing out something you already had. New money coming in, we call new business. So the ideal rally is old business and new business. If you don't have any new business, once the short covering is over, now you can come back down through the original range. And what I said on the tweet, if you go back and print at the A period high, again, and you start getting 3 wide there, now you got the potential to go all the way to the downside. Okay. So early this morning, it was very important. We wanted to just see how you could see the confidence, how you could get some idea that this market might rally. And now I want to show you how you get some idea that all it was some short covering. And once that's over, watch out. The market has made some correction to overnight inventory, but we only got partially into overnight range. Okay, continue to turn it on. Remember, I put out in the tweet, if you trade down and close off the distribution, okay, we've closed the distribution. I'm sorry, there's closed the distribution. Now, the odds are pretty good you can trade to the other end of that distribution. You didn't make the overnight high. You didn't have any new business coming in here. Okay, let's speed it up to about 10 times. So we're going to play this pretty fast in here. So we're going 10 times the regular speed. So what we've seen so far, we've seen a failed upside breakout. Okay, now the market's working to the downside. Jen, let's go back and remind everybody of the low from the 17th. Look at the low from the 17th. It was exactly at the high from the first lower distribution to the upside on the 16th. In other words, that's where the market left one distribution and started another. Very visible, very easy to see, which is what a lot of short-term traders look like. So that is a potential target to the downside if we get any more to the downside out of this market. And so far, we tried to go lower. We tried to go higher. We didn't even seriously, spend any time in the overnight range. So that's an indication that shorts recover. That's an indication there was some selling in there because we couldn't even get to the high of the overnight range. So now we're looking and we're always looking at the clock to say how long until the next time period. How much left is in D period?
A little over 5 minutes.
Okay, so D period's almost over with. So we looked up above, we failed, we came back, said once the distribution is closed, the potential for selling exists. You now take a look at your low. You now have a poor low because there is no excess on the low. The odds of taking that low out are very high. Okay, so you see the low is taken out. The downside reference is the day before's high And we said it was just very questionable because of its exactness. Now, everybody thought we were crazy because, from that time in the morning, when it happened yesterday, the market traded higher all day long. And it doesn't sound, when I'm pointing that out, it doesn't sound very realistic. But you saw how it came back into play today. So now we're back down and we see extension on the downside. So what have we done? We've taken out that questionable low from the 16th. Now let's look to the downside. So we've taken that low out. Can we look at the profiles a little bit on the lower side? Okay.
You mean like the 16th?
Yeah, look at the down there. It says 200-day simple moving average. Now, I don't look at a lot of technical things, but the 200-day simple moving average, I do look at because there are a lot of even money managers and bigger traders, for some reason, do look at that level. So again, I'm not a technician. I don't have a lot of technical things. I do look at the 200-day simply because I don't live in a vacuum or trade in a vacuum. I know a lot of people do follow that. Okay, so in the market, remember, we looked above and we failed. So now when the market's coming down, you just don't stand in its way. Now notice where it bounced from. Everybody see where it bounced from? Just from above the 200-day simple moving average, which is at 2770. So when it goes to a mechanical level like that, it's got to be very suspect. All right, see how it bounced? It went back up. Okay, now let's stop again. So now it went down to the low from the 16th. So it looked below the 16th. Now go up and show us how wide this range is. See all that empty space in there? The odds of keeping that much single space are very poor. So now as we go on this, you say, well, wait a minute, let the market work for you as it starts to break down. But you looked below the low of the 16th and no follow through. So now it would be unlikely that you would keep all those single prints. Sometimes you'll see it, but it's unlikely. So let's go ahead and play. Remember, we're playing what, 10 times right here?
Yes, 10 times speed.
Okay, let's stop for a second. Now, what I do if I have a short position on, when the market makes a big spike down like this, I just kind of automatically take my short trade off. And you could do a couple things. Oh boy, if I took it off here and it really went lower, I'd really feel dumb. But you don't give a lot of consideration. What would I feel if it bounced? But I'm looking at the odds. I'm saying, how many times have I seen this many single prints remain? Not very often. So from an odds standpoint, it breaks down, and I'm just going to at least cover some of it. Now somebody's going to ask, well, how many is a lot? Single prints. How many isn't a lot? I can't give you that answer. Those are the things you learn from sitting down, observing the market. Each market's going to be a little different volatility, a little different context, but I just want you to get a feel for it in here. Remember, this is simply the last day of the last video, the foundational course. I simply want you to have some feel of where you want to get over the long term. And Jen has scheduled these things for that exact purpose. When she's worked on a mix of videos that we have in there, it's towards that same goal. Number one, to give you a foundational guide to the market, but to have some idea where you eventually want to go to. Now, you're not going to get there quickly. You're not going to get there quickly at all. On the TED channel the other day, I saw a video, and it was a guy teaching piano, a very accomplished pianist. And he shows the student year one, bang, bang, bang on the keys. Year two, a little more rhythm, but still banging on the keys. About the third year he's taking lesson, he's only banging on every other key. And then finally, when you have, it's an art, not a science. And finally, you get to the point where he's just playing the piano. It's smooth, and it's not this boom, boom, bang. So you notice how this comes along. And this is what trading is about. It's not, you can make more money as a trader than doctors and lawyers and all of that. You're not going to walk in, take a couple of courses, whether it's from us or anybody else, and all of a sudden find yourself a competent trader. You may want to, you may dream about it, but that's not how it works. It comes over a long time with a lot of work. But imagine if you don't start in the right place and you don't really know what it looks like, where you want to end up. Think how easy it is to go off track along the way. And that's what this is we're kind of giving you a bookend approach here. Here's where you start. Here's what it looks like when you end up. Oh, by the way, take the next few years and fill it in between. Okay, let's go ahead and play a little bit more. Let's speed it up to about 20 times. So remember, we're playing very fast just to give you an idea. So remember, we said all those single prints, it's unlikely that you leave all those. It happens. Now, take a look at the current low. It's exactly at the 200-day simple moving average. Again, see how mechanical that was? One more time. When I see something that mechanical, I think there's a pretty good chance we're coming back to it through it. Again, it's observation. Now, if you're one type of trader, what we call a fast trader, when it goes down to that simple 200-day moving average, you can buy it. But you have to have a mindset that says, I'm in it for a short period of time. I'm in it only for a bounce. If you're trying to buy it as a longer term trade, even for the rest of the day, not a good idea. It's a different mental mindset. Okay, so you saw we did come back down through the 200-day simple moving average. Now, if you look again, we only went, I think it's 2 ticks below the low of the 16th. So it's 2 ticks of excess. That's fine, but it's not a lot. Okay, now notice the rally up here. We've taken back a lot of those single prints. Let's take a look and see what the top looks above there. Okay, so now where we are, coming back down, getting 3 wide. So the market's trying to find balance. Markets are always looking for a level where two-sided trade can take place, whether it's the longest term auction or the shorter term auction. That's what markets always doing, looking for a level where two-sided trade can take place. That's like any business, right? If you've got the greatest piece of merchandise in the world, nobody buys it, you don't have a good business. You need two-sided trade. Markets are the same way. Okay, so we're getting a lot of volatility, a lot of range in the afternoon. Keep in mind, while the low may hold, but it's only 2 ticks below the low of the 16th. Just a piece of information that you're carrying forward. Now, what you don't let that stuff bring you to a standstill, but you want to be able to remember that it's there and see if it comes back into play. So the market's, remember this, now the market's balancing. It's almost about 2 hours in the center here. Okay, coming back down, checking out those early morning lows. A lot of times what happens, traders, they get some balance and then they're trying to sell every rally. Okay, so you see now we're coming back down. We said 2 ticks wasn't much. Let's stop for a second. Now the context is always important. If it was a day with a narrow range, 2 ticks may have been fine. But you think about the range and the volatility on this day, 2 ticks becomes very questionable. Okay, let's continue to play this. Okay, you sit with 2 ticks, not a lot. Okay, now we're getting just about to the point where I wanted you to see what goes on this afternoon. So let's stop for a second. Remember this morning, or in the early part of this, I talked about they're selling and they're not getting much. They're selling, they're not getting much. They're selling, and they're not getting a lot. We're going to see that same concept coming up here. And remember, we're playing at a fast speed, but I'll try and point it out. Okay, so the markets, sorry, let's look below this so we can see the profile below this. Okay, so you see the low down there from the 15th. That is one place the market may be going. Okay, let's continue to play. Pushing down, H period. Look how far. Okay, H period came back quite a ways. Back down we go. I period. Quite a rally. Look at that. We go down and extend on the downside. Look at this rally. The low's no good. It's a poor low, matching lows. Okay, they took those out. Look at the rally. Look how far it comes after. So get this feeling. Every time it goes down here, there it goes again. Boy, you said this market's going down forever. But keep in mind those rallies you saw. See how big that rally is again? Market's back down to the low. Okay, now hold on. Stop here. We're going to let the rest of the day play out. But what I wanted you to see, the exact same action we saw in the morning when the market was pushing lower, and then you go back to half back a little above it, and they were working awfully hard, but they weren't getting a lot for it. Now, that was on a very tight branch. Right now, you've got a bigger market, you've got a bigger range, you've got more volatility, more people involved, but you're watching the exact same thing go on here this afternoon, and the shorts are going to get trapped. Okay, play it out, please. Just remember how big those rallies were.
Let me know if you want me to make it faster.
No, that's okay. Okay, again, remember all those how big those rallies were? Yeah, and then they take it back down, take it way down, way up, way down, way. That process was the market getting too short, but too short with this afternoon group. And now you see what's happening as we get later in the session. Okay, we can play this out at full speed now, or play it out at 40 times, 50 times. I wanted you to particularly see the morning. I wanted you to particularly see the afternoon, because if you're stuck on following price, you're going to get caught. You're going to get caught. You're going to get emotionally caught down there. If you see how big those rallies were, you say, uh-oh, wait a minute, this market's getting short. What you had down there, you had what we call laggards that kept selling the market. In other words, they didn't sell till they had all this evidence, and then there were other people down there buying. So now, as we're getting near the close, notice the 2770, the 200-day moving average. We're back and forth through that level. Okay, now we're playing out at full speed, but you see how that trap happened on the bottom. I mean, this is that's a lot of money that markets come up. But you saw that process on the low. They went down, big rallies, went down, big rallies, down, big rallies. And that's the process by which the market's getting too short. It's the process by the weakest hands traders are getting short, and they're going to get squeezed to the other side before the day is over. So now we're trying again towards the lows. Remember that 200-day moving average in there. That's a lot of volatility in there. So you got back and forth the 200-day moving average. This is where traders get hurt. If you don't understand what was going on the way down, you end up getting trapped or getting whipsawed. Okay, so the day is over. And we can stop it here. We've seen what we wanted to see in here. So again, I don't expect you to walk out of this and be able to trade a day like this. That would be unrealistic. But I really wanted to give you a sense of what it really is like. And that's what Jen and I and RJ are always trying to work towards. We're trying to work towards realism, not false promises. You buy here, sell here, you're going to make all this money. This is how easy it is. It's not easy. Is it doable? Yes. Is it challenging? Yes. Is it rewarding? Yes. Does it take effort, concentration? Yes. But anything that's worth a lot, that's how it happens.